Hey everybody, so in this video I wanted to really address the kind of insurance situation that's going on with the California fires, but really address it to why you need to make sure you look at the type of insurance that you have and what your coverages are to know that you are protected. This is not a video to sell you or to say, oh yeah, here, let me quote and make sure about. All right, back. It's not a video to like sell you on anything. If you know me, you know that's not what I'm about. I try to do all my videos on educating you guys because this is a very important topic. Obviously right now it is like considered like mainstream. It's all over the news, been all over the news. It's a tragedy to what has happened. And then obviously both sides are trying to politicize it for whatever their ultimate goals and gains are. But it's either here nor there when it comes to insurance. So a little part I want to start out, right? A lot of insurance carriers have in the recent years, and most notably, probably the most popular one was State Farm, pulling out of certain areas, if not the whole state in California. The reason is because they were having losses, and they were also looking at the risk. They were saying, hey, listen, we need to increase our rates in order to offset what we feel is the risk of something happening in order to be a profitable company. Insurance companies are a profitable company, right? Companies out here don't just run and be in, non-profitable companies. They have shareholders to report to. Most of them, especially your big names, are publicly traded. So have responsibility, that there's stocks to look at, everything like that. So they're for profit. Now, one can argue, right, insanely greedy, take advantage of people. Yes, I'm not going to disagree with anybody on that argument. However, they're not in the business of losing money. So when they went, especially State Farm, went to the state of California and said, hey, we got to increase our rates more because California put a cap. I don't know what the cap is. Let's just say it's 10% a year. I don't know. They said, hey, listen, in order for us to renew our current customers, we need to increase the cap by 20%. And again, I'm giving a hypothetical situation. California, the state legislators, whatever, bureaucrats came back and said, no, you can only increase it 10%. Well, State Farm said, well, we can't renew people because it's too much of a risk. We're going to lose money based on the law of large numbers, which is what insurance companies use. So the state of California, the people that they got elected to represent them said, nope, still not doing it. All right, well, State Farm said, bye. And my understanding, I think I saw one stat, and I'm not holding me to this, I don't have notes there, but is the Palisades, right, which is where like kind of like the big fire started and wiped out like the whole area, which is like majority of like everyday people, and that's why I'm doing this video. It wasn't like obviously celebrities were mixed in with this and stuff like that, but the Palisades, from like the understanding, was like everyday people who had been owning those properties for years and years and years, and family given down. And so these are like everyday working people. Now in California, probably still making six figures, but for California's sake, everyday people, working people. But obviously just the value of California went up, and so their home values, went up from, hey, they bought this home 25 years ago for $300,000, now it's worth, $3 million. But obviously these people don't have the financial ability to go out and buy a $3 million house. They've just lived in it, and it's just appreciated in value. So when California pulled out, obviously these people, or the State Farm, California pulled out, when State Farm, my understanding, I saw it was like 60% of the Palisades State Farm did not renew because of literally noted in writing from whatever the representative of State Farm saying due to basically fire risk, right? That was noted by an insurance company before all this. And they said, this is why we're pulling out, because of the fire risk, and we're not able to get to the rates to offset not able to increase the rates to offset the risk. Bye. I'm not over here like cheering for State Farm by any means, but I think if you really think about it, have a little bit of common sense, that would make sense, right? I don't want to do anything where I have a higher risk of losing money than a higher risk of gaining money, right? That's business 101. So, obviously now we have the fires happen. So what I want to break down now is kind of skip and talk about the types of coverages, right? So there's different types of coverages. There's mainly two when you're talking about your home. One is called actual cash value, which really, I don't even do it. I don't like to do it. If I do it for you, you will know it. I will probably say, hey, don't recommend this, but it's what you want to do for the cheaper insurance, sure, right? As long as you know it, understand it, right? The consequences of if and when something does happen, I will do it. But typically every time people want me, I'm going to shop you what's called replacement cost. A lot of people get this confused, and I did too. Before getting into insurance, I didn't know this, right? You think, oh, well, I bought my home $500,000, have $500,000 of coverage, so my home burns down, the insurance company's going to write me a check for $500,000. Absolutely not. That is not the case at all. Now, actual cash value, what they're going to do, let's say scenario, right, where one of the few scenarios where actual cash value is not terrible is you bought a brand new home, all right? You bought a brand new home. Government says homes depreciate over 27 and a half years, essentially, right, in total. Because that's how they do the write-off. So I'm just going to use that as an example. You bought a brand new, $500,000 house. It's a 2025 house. Actual cash value is not that bad, right? Because nothing has depreciated in its years. Everything's like less than a year old, essentially, right? So there has not been depreciation. So if something does happen, right, essentially cash value, yes, at that point, they're going to go out, depreciate what they can, which is a very small depreciation amount, and essentially, quote unquote, let's just say, stroke you a check for $500,000. Now, let's say somebody buys a 1972 house for $500,000. Now, there's some updates. But the roof is 10 years old. The HVAC's 12 years old. Water heater's 5 years old, right? So they're not, their expected life, for some cases is at half or, only a third left. That's what cash value does. It will depreciate that. So let's say they said, all right, well, that's a brand new roof. It's a $30,000 roof. And for the sake of easy numbers, let's just say $30,000 roof. Typical roof, let's say they depreciate it 30 years. Typical roof, 30 years. Let's just use that as an example. It's $1,000 a year. Well, let's say if the roof was 12 years old, well, they're going to depreciate $12,000 off of the $30,000 roof. So that means they're going to write you a check for $18,000 because they're going to say, well, your roof is 12 years old. It already had depreciated its life. So you already got use out of its life. So now the remaining life is only $18,000. That is the cash value. And it's unfortunate because I have seen in certain circumstances, usually very rural areas or areas that don't have fire stations close by, stuff like that, may not offer replacement cost, which is what I'm pro of. And I'll get into that a little bit. But they will offer actual cash value because they will say, listen, if something does happen, total loss, we're going to depreciate it. Therefore, it's a cheaper amount. We know we're not going to give the homeowner all the amount. But some lenders, actually most lenders that know what they're doing, and the underwriter doesn't miss it, are going to require replacement cost. And if you send them a cash value, they're going to kick it back. Because if they're loaning, let's just say you did $500,000, and let's just say you put, for the sake of argument, you put, 5% down. What is that? $25,000. Well, the lender's going to need coverage for their loan. And if it's actual cash value and it's an older home, you're not going to be able to depreciate it like that. So cash value depreciates. Therefore, you will not get the full amount there. That's why it's high risk. That's why I don't like it, because if you do have a total loss, all of a sudden now your $500,000 house, it could be you're only getting a check for $200,000. So you still owe the lender $475,000. You don't have a house, and all you do is have a check for $200,000. So you still owe the $475,000 loan because you took it out. It's not their fault it burned down. Still owe the loan. You don't have a house, and you have a check for $200,000. You've had what I would call like a double loss. For now, you can't replace your home, and you still owe. You're literally upside down twice, which is a brutal part to be in. And that's where, I realized insurance when I first got into this. I tried over-explaining it to people. I tried spending 15, 20 minutes on the phone to really, and I realize people don't care. And that's kind of been understanding because I probably didn't care to an extent. I'd be like, hey, I just want insurance. Give me the cheapest you got. I just want to know I'm covered. But I didn't know what the numbers meant. Didn't know. Honestly, didn't care. So I have to realize that. But what I want to do is knowing that you probably don't care, is I do still want to try to find you the cheapest coverage, but also that is coverage that I would feel comfortable with giving somebody. And if something does happen, I would rather be you coming back to me about, gosh, Stephen, you know, thanks so much, because, you know, obviously it's a tragedy, something did happen, but the insurance that I gave you was able to give you full replacement cost, therefore rebuild the entire structure back. You got brand new everything, and you're moving in. Obviously, again, a very painful, awful process, but you're made whole again. You are made whole again, and that's what insurance is designed to do. Insurance is not designed for you to benefit. Insurance is designed to make you whole again, right? Something happens, it will make you whole again, right? If you have $500,000 in coverage and it only costs them $350,000 to rebuild the house, they do not give you the extra $150,000. Replacement cost is the cost for them to rebuild the house. It is not given to you. You don't have control over it, right? They're going to bring in, they're going to have somebody build it. And again, back to essentially what the home was, likewise, except you get brand new everything. I think most people are going to take that, right, for the scenario. But what's happened in California is a lot of these people, because of the cost of insurance, either had what's called ACV, the cash value, because it's cheaper, because they couldn't afford it. So they either had that type of insurance, which is now going to screw them out of $3 million house. So let's say they owed no money on it. So that's, you know what, I only need coverage for $500,000. Well, you just lost a $3 million house. Sure, you're going to get let's just say, for the purposes of it, check for $500,000. You just lost $2.5 million. Over probably what, you know, again, I don't know the numbers, but let's just say over what was probably $1,000 to $2,000 a year in extra coverage. But some people may not be able to afford it. So it's not, you know, it's some people are cheap and some people just can't afford it. So it's a terrible situation. And obviously the government's going to step in and probably assist and help in all of this. And I mentioned the other day, there's going to be scams from all this crap anyways, people taking advantage of the situation. But that's what I want, and I'm doing this video, is you need to look at the type of insurance you have. You want replacement cost. You want replacement cost. You do not want actual cash value. Make sure in your home insurance, don't have it with me, call whoever you have. So I just want to make sure I have replacement cost. Also, you want to see what that replacement cost is and make sure that it has kept up with the basically inflation, right? 5 years ago, your house is worth $200,000, right? So replacing it was probably $200,000. Well, replacing that same house now, it's probably worth $400,000, but probably does cost $400,000 to replace it because of inflation, materials, labor, everything's went up. So if your coverage on your $200,000 house is still $200,000, and even though now your house is valued at $400,000, and the cost to rebuild is $400,000, well, they're going to go back to rebuild, and they're going to say, hey, man, we can only rebuild two-thirds of your home for $200,000. You're going to have to pay again. You're losing again. So you got things like building in like some bonus replacement costs of like 25, 50%. I typically will recommend a 25 and 50%. Not all carriers offer it. Most of them will offer the 25. But even a 50%, right? So what that means is $200,000, an extra 50% of that is an extra $100,000. So essentially it'll help you rebuild up to $300,000. So it protects you from that inflation. So you don't have to like keep raising your rate every year. Kind of builds it in, but there's come a point where your home value goes up so much and it's going to cost so much to replace it. You're going to have to increase your coverage because your value and what it costs to replace it is increasing. So make sure you have that. Now let's get into your actual coverages and liability if and when something. Well, actually, before that, let's talk about your personal items. That number for your replacement cost has nothing to do with your personal items. Let's just say you have $50,000 of personal items. Again, two options. You can have actual cash value. You can have replacement cost. Get replacement cost. Get replacement cost. Get replacement cost. Reason is, you have an 80-inch TV you bought 5 years ago for $2,000. Replacement costs will replace that TV with an 80-inch TV that's brand new. That is replacement cost. It's replacing the TV. Actual cash value is going to say, well, $2,000, average lifespan of a TV 7 years. It's 5 years old, so they're going to depreciate that. So now they're going to write you a check for $400 of your $2,000 to replace your TV because you went cheap on actual cash value. Don't do actual cash value. Do replacement costs. Do replacement cost. Hope this goes viral of me saying do replacement cost. So that's your personal items. And again, you need to make sure, how much is my coverage of personal items? Let's say you have a gun collection. Let's say you have some kind of antiques coins, right? You got to make sure all this stuff in value is built in, and you need a record of it, right? If you have all these guns that you've bought, from friends under the table, and you got no paper trail of, well, how do they know you really owned it, right? So replacement cost is going to be accountable based on the things you can prove you own, stuff like that, receipts and transactions and everything like that. You just can't say, man, I had $200,000 of cash in my safe, my house burnt down, $200,000 is gone, I want $200,000. It doesn't work like that. You got to have a paper trail of it. You got to have proof with your insurance. But that's where your personal items are replaced because, again, you need your personal items back. And another way if people can kind of cut out the insurance is to give you cash value for personal items, which will make it cheaper. And usually it's not a ton cheaper. It's a couple bucks, it seems like. Pay the couple bucks and get replacement costs on your items. So we got that. Now, talk about liability and stuff. And this is where, if something in your place damages something with your neighbor, right? So let's just say, for example, this scenario with the California fires. Let's say your house is burning. Terrible. And there's a tree beside your house. It catches fire. It's burning. Now, your neighbor's house might not be burning, but if your tree that's burning falls across your fence onto your neighbor's house, boom, it hits, right? And then all of a sudden your neighbor's house catches on fire. Your neighbor's house caught on fire because of you, right? Technically, you are liable. So that liability will help offset that stuff there, right? So now your costs. Well, your neighbors, if you have $300,000 liability, which is arguably a good amount of liability, that falls on your neighbors there, and they have a $500,000 house, well, your insurance is going to pay for arguably $300,000, right? So those are also things you got to consider in the amount of your coverage. And that's why, going through and talking about insurance to me is to make you whole again and protect your assets. And by protecting your assets, if you're a person and you have a net value between your your stocks and your retirement and all that of $1 million, well, let's talk about some umbrella coverage, right? Umbrella coverage usually super cheap, a couple $100 a year. You can get $1 million, $2 million, $3 million. So if something happens, it'll come in and cover, on your auto side, on the home side, if something does happen, obviously everything that's underneath the umbrella, which is usually cheaper to go that route than actually increase your home coverage up to $1 million. So it makes more sense and it covers more things. So talk about that. But those are really serious things. So what happens is now that neighbor is going to sue you because they only get $300,000 from your insurance. And you have the extra $200,000 left over. Well, that's just suing you for the actual cost of the damages. What about emotion and all this crazy stuff you hear people getting sued for, right? Because if you sue me for something that I did, right? I pushed you down a set of stairs, right? And you turn around and you sue me, right? You're going to have basically access to essentially my net worth to some aspect, maybe future earnings. But you're not going to get near as much money off of suing me if I push you down the stairs as if Elon Musk pushed you down the stairs. If Elon Musk puts you down the stairs, you're going to get a lot more money than suing him than you would suing me. So again, that's where it gets into value, protecting yourself, protecting your assets, right? So who knows how much insurance Elon Musk has on himself, because if he ever does anything, if he ever trips and falls and on his way trying to catch himself, he hits a kid, knocks the kid over, kid breaks his arm, well, that kid now is probably a millionaire. For sure, right? Even though it was an accident, another was intentional. But again, insurance purposes, all that stuff. Again, just examples, hypotheticals. Shoot, I didn't do my GPS. I can't remember which way to take. I'm going to go right here. I'm headed up to some new construction homes there. But want to do this video to really, again, I'm more than happy to answer any questions. You need to educate yourself on insurance to the extent that you know what you are protected from and what will happen in all situations. Or if you say, you know what, I don't want to learn insurance, but Steven, I want you to do what you would do if it was your insurance, I will more than happy do that for you and answer any questions and not bore you with the boredom and the stupidness that is insurance and trying to learn it all. I'm happy to do either or. But that's why I really enjoy educating people, because I like learning new stuff. And insurance has been very humbling for me to learn, because what I felt was, I knew a good bit about, boy, I knew like a tenth of a tenth from what I know now. And I was still right. I'm not even a year in. And so I will imagine when I look back on this video in 3 years and 5 years, I'm like, boy, Steven, you were stupid saying some of that stuff, because you know so much more now, you know, a better way how to explain it, all that. But I only know what I know now. And I'm just learning as I go. But I do know what I want to do, which is help people and protect people, using this, as an insurance. That's why you never really see me out here like trying to just hustle and quote and call you and say, hey, let me quote. I don't want to do that. If you want me to help you, call me. I will help you. But that's not the way I run my real estate business, not the way I run my insurance. It's not the way I'm going to run any business. Like I want people to know that we're here to help. We're here to give honest advice. Man, side note, wish you guys see this. This is the world's biggest snowman I've ever seen. That snowman's like 10 feet around. It's crazy. Snow's been here for a week, how cold it is. But yeah, want to do this video, share that. If you have questions, let me know. Again, happy to explain it, or say, hey, here's the type of coverage you go back and tell your person. If you got good insurance person, keep your good insurance person. You know, that's fine. But if you have questions on it, let me know. I'm happy to help. See you.